Hey, I'm back with your weekly market insights brought to you by the Capital Markets Trading Desk. Every week, I break down what's happening in the economy, mortgage rates, and housing, breaking down the market so everyone can understand it. It was another important week for the markets as investors digested softer inflation data, a cooler labor market, and fresh housing numbers. Bond yields moved lower as weaker economic data strengthened expectations that the Federal Reserve is unlikely to raise interest rates in the near term, while stocks moved closer to record highs and the dollar weakened. Oil remained volatile amid geopolitical tensions, keeping inflation concerns in focus. So let's break down the numbers. First, let's talk about inflation. U.S. inflation remained modest in July, with core CPI rising 0.2% month over month and 2.5% year over year. That marked the slowest annual pace since March 2021, reinforcing the view that inflation pressures are gradually easing. And wholesale inflation told a similar story. U.S. PPI rose 4.7% year over year in July, down from 5.5% in June. On a monthly basis, the index was unchanged, helped by further declines in energy and food costs. Now, let's talk about jobs. The labor market showed more signs of cooling in July. Employers cut 23,000 jobs, while previous payroll gains were revised sharply lower. The unemployment rate dipped to 4.1%, but labor force participation also declined while wage growth slowed. Meanwhile, jobless claims remained near historically low levels, but moved higher. Initial claims increased 9,000 to 209,000 for the week ending August 8th, while continuing claims fell 22,000 to 1.7 million for the week ending August 1st. So while layoffs remain relatively low, the broader labor market is showing some signs of losing momentum. Let's turn to housing. Mortgage demand picked up as borrowing costs edged lower. The MBA mortgage applications index rose 3.6 in the week ending August 7th, reversing a 2.9% decline the previous week. Purchase applications increased 2.5%, while refinancing applications rose 5%. The average 30-year mortgage rate also edged down to 6.77 from 6.81. But despite the improvement in mortgage demand, the broader housing market remains under pressure. Existing home sales fell to a 3-month low in July as high home prices and mortgage rates continue to weigh on buyers. Sales dropped 1.7% to an annualized rate of 4.06 million. So, what's the big picture? This week's data points to an economy that's still holding up, but clearly cooling. Inflation continues to moderate, the labor market is losing some momentum, small business confidence is improving, while housing remains under pressure from elevated prices and borrowing costs. And with treasury yields falling, the dollar weakening, and stocks moving toward record highs, markets are increasingly focused on what the Federal Reserve does next. So looking ahead, investors will be watching upcoming economic data, additional labor market and inflation indicators, and any signals from Federal Reserve officials for clues about the path of interest rates. With markets already pricing in a cautious Fed, the next round of data could be critical for determining whether that optimism continues or whether investors need to rethink the outlook. And that's a wrap on this week's Weekly Market Insights. If you found this video informative, hit that like button, follow for more Weekly Market Insights, and share this with someone who wants to stay ahead of what's happening in housing, mortgage rates, and the economy. Until next week, stay informed, stay ahead of the market, and remember, nothing is beyond reach. Buffy out.